You guys got me? Hello?
Hi.
All right.
Hello.
I don't know what the hell happened there. How much, where did you guys stop here? Like, what did I stop on?
Does anybody have the last words?
You had said that something was interesting, and it was in regards to having a bank and trust be a trustee or something like that.
Okay.
Because I remember you had said, "Oh, that's interesting."
Yeah. Where was that?
Just after that, I think.
All right, cool. All right, you didn't miss much then. All right. Actually, you didn't miss anything. I just read the next two lines and that was it.
Don't be withholding information from us.
Oh, of course they are, man, because I'm getting to the juice. They didn't like me rereading that one line.
Hey, so is that the book you guys are going through right now?
Yeah, this is it right here.
Oh, I think I might have that at the house.
Brother, you need to get into this.
Yeah, I actually I just finished a trust and estate. Which one is it? It's one of the different books. It's not the.
Is it Crouch?
It's one of like the. What's that?
Is it Crouch? Author Crouch?
Yes, I think that's the one I was reading.
Jesus.
Your
But yeah,
executor duties.
I haven't gotten into this one yet. No, it's I think it's one of the
Organizing your estate.
I'll have to look at. I'm sorry?
Organizing your estate.
No, I think it's a different one.
Your trustee duties.
Hold on.
She probably has them all. She's reading off of her bookshelf.
Oh, really?
No, I'm just guessing.
Good guess.
Yeah, was it?
Yeah.
All right, so this is a really... Hold on. Got 2. Got 8 more pages in this chapter. And then we'll take a break. Chit-chat for a bit. All right, so because this is going to be a new recording, the other one's going to end up being split up, which really fucking sucks.
Gary Bayer, that's what it is.
I'm sure somebody will be able to download them all off of YouTube and put them all together in one clip. But anyway. So for all you Illuminati motherfuckers that keep cutting my feed, you CIA, NSA, FBI, alphabet, little homophobic motherfuckers, y'all can eat my ass with a spoon while I read this motherfucking sentence again.
It's frozen. I don't know. It just unfroze.
I will do it again, motherfuckers. For a trust to qualify as a Q dot, it must meet the following conditions. At least one trustee must be a U.S. citizen or a U.S. or state registered bank or trust company. The estate's executor must make an irrevocable Q dot election to qualify for the marital deduction on the federal estate tax return within 9 months of the decedent's date of death. If the Q dot assets are $2 million or less, no more than 35% of the value can be held in real property outside the U.S. unless... Ooh, and this is going to be nice. I already started looking at this a little bit. Uh-oh. Shit went out of fucking sequence again. I put this shit all in sequence early, and when I fucking transferred it over, it didn't stick. All right, so I got to find page 42. They put it all the way down to the bottom.
41 kind of looks like 47. Maybe that caused confusion.
Possibly. Hang on. I know it's going to be towards the bottom because it brought the one from the bottom towards the top. And this is why making it a one-man show is too hard.
So the right page should have a big gray box. Yep, there it is.
There we go. Making sure I ain't got a fire starting in my house here real quick. All right. All right, so we're still under qualifications for QDOT. The trustee is a U.S. or state-regulated bank. I think didn't they say that up top? Oh, no. Yeah. State register. Oh, regulate. Okay, all right. The trustee is a U.S. or state-regulated bank. The individual U.S. trustee furnishes a bond for 65% of the QDOT's asset value based on the values at the decedent's date of death. The U.S. trustee furnishes an irrevocable letter of credit from a banking institution to the U.S. government for 65% of the value. If the QDOT's assets are more than $2 million, then either the U.S. trustee must be a U.S. or state-regulated bank or trust company. The individual U.S. trustee is required to furnish a bond of 65% of the QDOT's asset value as of the decedent's date of death. The individual U.S. trustee must furnish an irrevocable letter of credit issued by a banking institution to the government for 65% of the value. Remember, the easiest way around the QDOT regulations is for the surviving spouse to become a U.S. citizen before the filing deadline, 9 months after the date of death, for the Form 706 estate tax return. If that's not an option because the surviving spouse doesn't want to become a citizen or because there's not enough time to become a citizen in that 9-month window, a QDOT election can be made by the decedent's executor within that same 9 months if there is no QDOT provision in the decedent's will or trust. Get screwed up here. Keeping tighter control, marital estate trust. The marital estate trust may be funded with almost all the deceased spouses, the grantor's estate, just like the unlimited marital trust. However, unlike the unlimited marital trust, the terms of a marital estate trust are typically less freewheeling. You, as the trustee, may have the discretion to distribute income as well as principal. At the death of the surviving spouse, who is also the trust beneficiary, the assets are paid directly into his or her estate, where they are included for the estate tax purposes. Reigning in the surviving spouse, qualified terminable interest property trust, QTIP. Really? This trust has nothing to do with cotton swabs. Instead, the qualified terminable interest property trust, QTIP beneficiary, the surviving spouse, receives the net income paid at least annually, but is not required to receive any of the principal during lifetime. Unlike the limited marital trust, where the trust beneficiary designates where the principal goes during his or her lifetime or after his or her death, the grantor of a QTIP trust makes that determination in the trust instrument. The trust beneficiary, the surviving spouse, has no say. All right. Understanding unified credit. The unified credit is the linchpin of the combined gift, generation skipping transfer, and the estate tax system. Although the amount isn't the same for all three types of transfers, the theory behind this is the theory behind this credit is, I kept wanting to say the. Unlike deductions, which are subtracted from taxable amounts before you calculate the tax owed, credits are subtracted from the actual tax that's been calculated. So in the case of the unified credit, you first calculate the tax due on the transfer being made and then subtract the credit from the tax. If the tax you calculate doesn't use the whole credit, the remaining credit carries forward to a subsequent year in the case of a gift and generation skipping transfer taxes. And in the case of estates, if the tax doesn't require the entire credit, the estate won't owe any estate tax. The unified credit is a cumulative credit. During lifetime, any amounts the decedent doesn't use carry forward. After death, you subtract whatever amounts the decedent previously used from the total amount of the credits available to the estate. So if Flo gave away taxable gifts that used $250,000 of her unified credit during life, at her death, her executor or administrator must subtract $250,000 from the total unified credit available to her estate. If she had an estate of $5 million, including her taxable gifts, which are added back for this calculation, when she died in 2009, the total tax on that amount would be $2,130,800, and the amount of the unified credit available for all transfers in the year of death was $1,455,800, or the equivalent of $3,500,000 of assets in 2009. Because she gave gifts during her lifetime that used up $250,000 of her unified credit, her remaining credit would be $1,205,800, or $1,455,800 total unified credits available. $250,000 amount of the credits used, and her estate would pay $925,000, or $2,130,800 total tax. $1,205,800 remaining unifying credit, not the $675,000 it would have paid if she hadn't used any of her ununified credit during her lifetime. In addition, in certain circumstances, the surviving spouse can now use a deceased spouse's unused exemption amount on the surviving spouse's later death. That was fucking confusing. I'll get it when I read it again later. I'm not going to worry about it now. Where it gets tricky is that the unified credit doesn't remain. Shit, where it gets tricky is where you threw all them damn numbers at me in the reading. Shit, what you talking about? Where it gets tricky. Where it gets tricky is that the unified credit doesn't remain a static amount. As Congress adjusts the amount at which transfers begin to be taxed, the credit rises, falls, or on occasion, even disappears. Because it's a moving target, if you're planning on making large gifts or even dying, what? You may want to consult a competent tax advisor to see what rules are currently in place. Man, I want to punch that dude for writing that in there. I'm planning on dying. Motherfucker, I'm planning on killing you. Protecting the estate tax exemption. We're fucking immortal, man. Quit fucking putting this subliminal messaging into our shit. Protecting the estate tax exemption. Credit shelter trusts. Under the transfer tax system in the United States, a person could transfer part, sometimes all, depending on size, of his or her estate without paying any tax on that transfer. During life, you're allowed to make annual gifts, sometimes referred to as annual exclusion gifts. $14,000 in 2013, adjusted annually for inflation in $1,000 increments that fly under the transfer tax system radar without counting against the non-taxable portion. But at death, all the decedent's assets are added up, including property transferred in excess of the annual exclusion gifts, and subjected to the estate tax. At this point, all right, cool, we were good. At this point, oh, so that was the page I was looking for the whole time, you motherfucker. Apologies for all the cuss words. I ain't got no filter. No, what happened here? All right, so we'll have to come back up when we get to 54. It's like ever since I seen Peto's video mention generation skipping, it's all I'm seeing everywhere now. All right, what was I? At this point, whatever portion of that allowable tax-free transfer, also called a applicable exclusion amount, the decedent didn't use during lifetime is subtracted from the total estate. The portion of the estate funds the credit shelter trust, sometimes referred to as the bypass trust or family trust, or the trust that holds the amount of the assets equal to the remaining applicable exclusion amount. Not coincidentally, this is the same value of assets on which the corresponding tax would equal the amount of the unified credit available on the estate if those assets were to be taxed. For a more in-depth discussion of unified credit, see Understanding Unified Credit sidebar. Technical stuff. Before funding the credit shelter trust, obtain copies of the decedent's most recent gift tax return, which should show how much, if any, of the unified credit the descendant used while alive. If the descendant wasn't too generous during lifetime, you have the full amount, $5,250,000 in 2013, adjusted annually for inflation. If the return does include taxable gifts, subtract the total of gifts, not the credit assigned to the tax assessed on those gifts, from the total amount of the estate's tax exempt from taxation to arrive. We'll start that over again. Not the credit assigned to the tax assessed on those gifts, from the total amount of the estate that's exempt from the taxation to arrive at the amount you can use to fund this trust. Lower your estate tax and make your kids and grandkids really happy. Funding children's and grandchildren's trusts during lifetime with annual gifts equal to the current annual exclusion amount gifts, not subject to the gift tax, $14,000 in 2013, adjusted annually for inflation in $1,000 increments, is a great way to remove assets from the grantor's estate, especially if that estate may be taxable at death. We once shared a wealthy client who religiously gave all the annual exclusion gifts she could to each of her children's and grandchildren's trusts. When she died, all of those $10,000 gifts, the amount of the annual exclusion at the time she made the transfers, had been invested for years, and the total value that was sitting pretty in these trusts far exceeded the size of her taxable estate, which was still huge. Had she waited to fund these trusts until after her death, the available pot of money would have been much smaller because her estate would have been paid 55% in estate tax. Yeah, that's pretty slick. Not gonna lie. Skipping generations. Probably the least likely answer to the question, what kind of tax do you think of when someone mentions taxes, is the generation skipping transfer tax, the GST. It is, as the name suggests, a tax based on the transfer of assets between generations that bypasses at least one generation along the way. Whenever the grandparent transfers property to a grandchild, for example, the intervening child, that is, the donor's child or grandchild's parent, is still alive. A generation has just been skipped, and you need to pay attention to this tax. Likewise, if a person makes a gift to an unrelated friend and there's more than 37 and a half years age gap between the two, the IRS considers that the transfer. What the fuck was that? Oh, it was my bearded dragon. My bad. The IRS considers that the transfer has skipped a generation. The GST tax rules are Byzantine. The concept of GST tax came about because some wealthy people were avoiding transfer taxes by moving their wealth to their grandchildren and great-grandchildren rather than their children. Instead of having their wealth passed stepwise from generation to generation with either a gift or estate tax being collected at every step along the way, these skip transfers had taxes, either gift or estate, collected only every second or even third generation. Like the big one that got away, Congress looked at the lost tax revenue and came up with a system to make sure that it assessed tax on every available step of the generational staircase, even if the assets never came to rest on each of them in turn. GST taxes are calculated and assessed in addition to gift and or estate taxes on transfers made to skip persons, the grandchildren or other recipients in the skip transfers, as with the annual gift tax exclusion. You can exclude a set amount each year from the tax if you meet the rules for qualifying for the exclusion, which are different from those for qualifying for the gift tax exclusion. You are also allowed to exclude a certain amount over the course of your lifetime and after your death. It would be awfully easy in that amount if that amount stayed the same year in and year out. Unfortunately, it doesn't. Some years GST exemption amount is the same as the overall gift and the estate tax amount that can transfer without paying a tax over the years. Other years, the amounts are different. But just like the gift tax and estate taxes, the amount of generation skipping transfers you make is tracked cumulatively over the course of your lifetime, not just from year to year. Small and moderate-sized estates can usually avoid the GST tax altogether, even if they make transfers to grandchildren and the like. In larger estates, it becomes a question of getting the most bang for your exclusion buck. For example, large estates often apply GST tax exemptions to trusts funded with life insurance policies. The grantor applies the GST tax exemption against only the transfer of cash to pay the insurance premiums. When he or she dies and the face value of the policy is paid into the trust, the new value of the trust far exceeds the amount of GST tax exemption the grantor used to fund it. But all of those proceeds are now GST tax exempt. You guys still with me?
Yep.
Okay. Checking all my settings, making sure everything's good. All right. Grandpa or grandma knows best. Grandchildren's trust. If you're not sure whether your children are ready to handle large sums of money, chances are good you're even more convinced that your grandchildren aren't ready. Grandchildren's trust are like children's trust in almost every respect, except one. Transfers made into trust created for grandchildren are subject to the generation skipping transfer tax. Check out Chapter 17 and the nearby sidebar, skipping generations for more on this tax. And remember, any GST tax you pay is in addition to any gift taxes or estate taxes owed on the transfer. Grantors often create these trusts to provide funds for a specific purpose, such as education or the purchase of a home. These trusts often allow the trustee a great deal of discretion when choosing to make distribution for another purpose. As with the children's trusts, the grantors often create them with an end plan in place so the principal is distributed to the beneficiary at specific ages. Better safe than sorry, insurance trusts. Many grantors hold assets, such as a company they own or the family farm, that can readily go into a trust, but those items still have real value and are part of the total estate when calculating estate taxes. Of course, if that type of asset represents the bulk of the decedent's estate, the estate may not have enough cash to pay the taxman when the time comes. Either the insurance trust, a type of irrevocable trust funded during the grantor's lifetime, an insurance trust uses policies plus a small amount of cash as the only type of asset. The trust owns the insurance policies on the life of the grantor, and the trust is the sole beneficiary. In fact, insurance trusts are a reasonably inexpensive way to make sure that adequate funds are available to pay the cash needed of the decedent's estate that may be otherwise short of cash, without forcing a fire sale of other assets that may not be readily marketable. When the grantor dies, the proceeds from the insurance policies are paid into the trust. Money is then available to pay the debts of the decedent and the estate, including any estate taxes due. If the trust is structured correctly and the premiums have been paid by using the grantor's annual exclusion from the gift tax or some of his or her lifetime annual exclusion, the face value of the life insurance policies on the grantor's death isn't included in the grantor's estate for estate tax purposes. Oh, yeah. Okay. It's only a name, not a description. Crummy trusts. In a crummy trust, creating the illusion that the beneficiaries have the right to use the gift at the time it's given, a present interest is the key. Without a present interest, the grantor can't use the annual exclusion to eliminate any gift tax consequences. Technical stuff. Crummy trusts are named for Crummy v. Commissioner, a court case decided in the U.S. Ninth Circuit Court of Appeals in 1969. The case enabled a grantor to make a gift into a trust of a present interest in property that wasn't really a present interest gift, while claiming an annual gift tax exclusion for it at the same time. Remember, in a crummy trust, the grantor transfers money equal to or less than the annual exclusion amount into a trust set up for the benefit of his or her children and or grandchildren. When the gift is made, the trustee sends a letter to all the named beneficiaries informing them of the gift and telling them that they have the right to withdraw some or all of that gift within a specified period of time, usually 30, 45, or 60 days. When the beneficiaries fail to take the money out of the trust during this period, and the grantor, trustee, and beneficiaries all understand the beneficiaries won't be asking for their money, their ability to do so lapses, and the money now remains inside the trust and is available to pay life insurance premiums. This ability to withdraw the contributions at the time they're made, even though no one ever exercises their right to do so, creates the present interest required for annual exclusion gifts and is called a crummy power. In a crummy trust, the trustee is responsible for investing the cash, allowing it to grow over time. At some date far in the future, distributions may be made to the beneficiaries, many times to pay for education or for the purchase of a new home. In some cases, the trust terminates at a specific date or when the beneficiaries reach certain ages, with the principal being paid out to the beneficiaries In others, the trust may operate long after the contributions have been made to it, paying income and or principal to the beneficiaries according to their needs. Many grandparents have paid for their grandchildren's college education by funding crummy trusts for them. Although these trusts aren't afforded any income tax breaks, unlike specifically designated college savings accounts such as Section 529 plans or Coverdell education savings accounts, crummy trusts may be far more flexible than either of those accounts. With a crummy trust, the principal doesn't have to be used to pay for the education, and the distributions are discretionary. So the grandchild who may land a 4-year free ride for whatever reason won't have a mountain of unnecessary college savings. Let me read that again. So the grandchild who may land a 4-year free ride for whatever reason won't have a mountain of unnecessary college savings. And the grandchild who may otherwise qualify for an outright grant or scholarship money won't be penalized because of money that has been explicitly set aside for his or her education. Keeping a finger in the pie. Grantor retained interest trusts. Sometimes grantors want to put specific property into trust but aren't sure that they're ready to lose the benefit from that property yet. Welcome to the world of grantor retained interest trusts, where the grantor makes the gift of the property into trust but holds back an interest either in the income from the property or the use of the property for a specified period of time. Because the grantor hangs on to an interest in the property transferred for a specific period of time, you may be tempted to view these trusts as grantor trusts, discussed earlier in this chapter, so that no gift tax returns would be required because the grantor didn't give up complete control of the property in question. Grantor retained interest trusts are more of a hybrid, though. Although the grantor keeps an interest, that interest is infinite, and the transfer of property into one of these trusts constitutes a gift that requires filing Form 709. But the value of the taxable gift isn't the same as the value of the property had in the hands of the grantor. Instead, the gift tax value is the value of the property at the date of the gift, less the value of the grantor's retained interest. Tip: why bother with the grantor retained interest trust? To reduce taxes. Using these trusts can substantially reduce the transfer tax value of a property by using today's values instead of a higher value years down the road, which will result in higher tax. This isn't foolproof. Sometimes value shrinks rather than expand, but while you should never make any estate planning decision purely based on the tax consequences, we've both been involved with plenty of these trusts where a large potential transfer tax bills were almost entirely eliminated because the grantor created a grantor retained interest trust. Grantor retained interest trusts come in many varieties. Among the most popular are the following: grantor retained annuity trusts, GRATs. The grantor transfers property into trust and receives a regular fixed payment from it based on a percentage of initial value of the transfer for a period of years. You guys still with me?
Yes.
Okay. Grantor retained income trusts, GRITs. The grantor transfers property into this trust but holds on to the income earned by the trust for a period of years. At the end of the period, the property either distributes out to the beneficiaries or remains in trust, but now the beneficiaries receive the income. Grantor retained unit trusts, GRUTs. Where's Groot? There's got to be a Groot in here. All right. The grantor transfers property into trust like with the GRAT, retains the right to receive an annual payment from the trust for a period of years. Instead of a fixed annuity amount determined when the trust is initially funded, the unitrust payment changes annually and is calculated based on the asset evaluation done on a specific day each year. In many cases, that date is the second business day of the calendar year. Don't ask, we're just responsible for telling you the rules, not making them. Qualified Personal Residence Trust, QPRTs. The grantor transfers his or her home into the trust, retaining the right to live there, rent-free for a period of years. After the specified period ends, the property now belongs to the named beneficiaries, usually the children, sometimes the grandchildren, and it's up to those beneficiaries whether to allow the grantor to remain in the residence. It's very important, though, that the grantor now pays the new owner's market rent for that house if he or she continues to live in that home. Otherwise, the IRS may decide that the grantor never actually made the gift and therefore still owns the house. Seek advice. The rules for structuring a grantor retained interest trust and for determining the gift tax value on the property transfers into the trust aren't for the weak of heart. If not done correctly, the IRS may come along at any time and disallow the gift. Unlike income tax returns, which have a specified statute of limitations beyond which time the IRS may not question the return unless they suspect fraud, gift tax returns remain open items with the IRS until a taxpayer's death. The IRS can still question the gifts made 30 years ago, changing valuations or even disallowing them entirely. If you're thinking of setting up one of these trusts for yourself, find an expert estate planner with plenty of experience to draft the necessary documents and prepare the gift tax returns. And if you've been named as trustee of one, get a second opinion and have a professional of your choice review the trust instrument. That way, if the document is fine and the valuations are dandy, you're only out a relatively small fee. But if you do have a problem, your expert will hopefully find it and correct it before the IRS catches on. Just want to check something real quick. No? Okay. Oop. Too far. The rule against perpetuities, Property 101. The law historically didn't like property to be tied up in trust forever. In states that follow the traditional rule against perpetuities, hello, you just said it, a trust must be structured so that it terminates no later than 21 years after the death of a specific living person or persons referenced by name or relationship in the trust document. For example, the document may end the trust no later than 21 years after the death of the last to die of the now living descendants of my grandparents and my spouse's grandparents. Note that those descendants needn't be beneficiaries of the trust. Referencing them merely gives the trust the possibility of a longer life. In states where this rule still applies, a well-crafted trust contain a fail-safe provision which provides that whatever the provisions of the trust, it won't violate the rule against the perpetuities. Nowadays, about half of the states allow a uniform law that provides that an interest in a trust must vest within 90 years of when the trust was created, or the trust will be reformed by the court to meet this requirement. Some states actually have repealed or are repealing their rule against perpetuities laws to take advantage of a tax loophole that was created regarding dynasty trusts. These states hope to attract more trust business, or at least keep trust businesses from going elsewhere by eliminating the rule against perpetuities. Exploring charitable trusts. Whether you've been extraordinarily fortunate during your lifetime or you prefer that your assets go to charity rather than to your family, whom you may feel you've already given enough to, establishing and funding a charitable trust are increasingly popular elements of estate plans. The days when only the extremely wealthy created private foundations and other types of charitable trusts have disappeared. Now, even people with more modest means are discovering that instead of gifting money directly from your personal account to a particular charity, you could be charitable and reduce your tax taxable estate tax at the same time. Remember, charitable trusts allow you to transfer assets out of your estate with the goal of using all or a substantial part of that property and the income earned from it to act charitably. What better feeling can you have than seeing your money be used for worthy causes? Well, that depends on who the CFO of that particular charity is and where the actual funds are going. Of course, because charitable gifts carry with them tax consequences, and because most people have not come to rely on tax consequences when making major decisions, giving to charity is rarely as simple as dropping a few coins in a bucket or mailing a check to a worthy recipient. By funding a charitable trust, you not only enable yourself to give a current gift, but also provide the means from the same assets to make future gifts, and you are only entitled to remove these assets permanently from your estate, reducing your taxable estate. And you aren't only entitled to remove these assets permanently from your estate, reducing your taxable estate, but also to get a healthy income tax deduction up front for the transfer. In many ways, it's a win-win situation. The next section discusses the two major types of charitable trusts that grantors may create. Split interest charitable trusts. Mika, be quiet. I'm reading. Split interest charitable trusts are trusts where the grantor retains an interest in the trust property. The grantor may create a trust enabling him or her to receive payments during his or her lifetime for a period of years, after which the remaining trust property is given to charity, so-called charitable remainder trusts. Or the trust may permit set payments of charity from the income and principal for a period of years, the charitable lead interest. After that period expires, the remaining trust principal is distributed to the remainderman or to the people entitled by the trust instrument to receive whatever's left after the charitable lead interest expires. So-called charitable lead trusts. The four major types of split interest trusts are charitable lead annuity trust, CLAT. Okay, there isn't a CLIT. Okay. Charity receives a fixed annual payment, because I didn't want to run into that, but then I just said it anyway, so whatever. Charity receives a fixed annual payment every year. Payments are calculated as a percentage of assets value of payments are calculated as a percentage of asset value as of the date the grantor gifts the property into the trust. Man, I butchered the hell out of that. Charity receives a fixed annual payment every year. Payments are calculated as a percentage of asset value as of the date the grantor gifts the property into the trust. Jesus. Charitable lead unitrusts, CLUTs. Charity receives annual payments calculated on a percentage of the assets valued as of the second business day of every year for a fixed number of years. Charitable remainder annuity trusts, CRATs. The grantor receives payments for life based on a percentage of the value of the assets on the date the trust is funded. Charitable remainder unit trusts, CRUTs. The grantor receives payments for life that are fixed annually based on percentage of the value of assets, which are usually valued on the second business day of each year. All CLATs, CLUTs, CRATs, and CRUTs, try saying that 3 times fast, must file an annual income tax returns. What makes this an interesting exercise is that these forms aren't typically fiduciary income tax returns, like the ones described in Chapter 18. Instead, Form 5227, Split Interest Trust Information Return, is your form of choice. Note that Form 5227 is an information return only. No tax is ever due. If the trust you're administering is a remainder trust, you have to give a Schedule K-1 from the trust to return to the income beneficiary, who will then be responsible for including on his or her personal Form 1040 all of the items of income and deductions shown on the K-1. We discuss how to complete Schedule K1 in Chapter 20. Ooh, that's going to be fun to get to. Scroll. Give me a sec, guys. I got to crack my neck. All right. Warning. Don't fail to file your tax returns, including any required state returns. Just because you're not paying any tax doesn't mean that the IRS doesn't want to see what's happened during the year. Failure to file the Form 5227 carries a hefty filing penalty, calculated on the number of days, its date, and maxing out a whopping $50,000 per return. And the IRS very, very rarely abates it. It figures if you're swift enough to figure out the positive estate and income tax consequences of setting up one of these trusts, you're also swift enough to make sure that you file the tax returns on time. Although ignorance on other tax matters may sometimes earn you IRS sympathy, it doesn't here. Non-operating charitable foundations. You may have heard of the Ford Foundation, the Rockefeller Foundation, and more recently the Gates Foundation. These are non-operating charitable foundations, sometimes also referred to as family foundations, which are established by some very philanthropic, hello, you know the word, say it, folks, in order to further their charitable goals. Oh, that's so fraudulent, because we know the Gates Foundation is all about fucking population control and wiping us out. Although these foundations may be incorporated and be run by the full gamut of corporate officers and directors, they may also be governed by a trust instrument and trustees. For many smaller foundations, the trust route is the way to go because the tax reporting requirements are the same and they don't have any corporate filing obligations. Supercharging your charitable giving by setting up a foundation. Creating a charitable foundation gives new scope to charitable giving. Now, in exchange for the rather hefty charitable donation you can claim on your income tax return each time you transfer assets into that foundation, charitable giving is no longer optional for you. The knowledge that you're required to give at least 5% of the average value of the assets in the foundation each and every year turns you and other members of your family into much more committed and inventive charitable givers. There's a cost to be paid, though. In making a large gift to a charitable foundation you've establishing the foundation's tax-exempt status and annual tax reporting, in order for you to take charitable deductions for gifts you make into the foundation, you must obtain an IRS determination letter stating that your foundation is a qualified charity. I have to scroll here, huh? Filing for tax-exempt status. To do so, file Form 1023, Application for Recognition of Exemption under Section 501c3 of the Internal Revenue Code. Expect that your application will be rejected at least once, but know that this is a situation of, if at first you don't succeed, keep trying. The IRS will give you explicit reasons why it has kicked back your application. Fix up those problematic sections, and then resend it. Obtaining tax exemption is a key element for your foundation. Without it, you may as well not have one. Everybody with me?
Yes.
Okay.
You look frozen.
Good now?
No.
You're still frozen?
Yes.
Anything?
Audio's okay.
Audio's
Yes.
okay. Just
Unfrozen.
unfrozen. All right. It's probably just lagging then, or I'm
Fro-
lagging.
Frozen.
All right. It's just lagging. You'll probably get the full recording when you download it
Okay.
without any issues. Where was I? After you've filed your application, you also have to file an annual Form 990 PF, Return of Private Foundation. Don't wait until you've received your determination letter before you begin filing annual Form 990 PFs. Instead, assume you'll eventually receive your exemption. Form 990 PF, although not an income tax return, is an excise tax return, and you'll be required to pay either 1 or 2% of your net income as excise tax. Unlike most other types of trusts, family foundations are allowed to use fiscal year end, ending the tax year on the last day of any month, not just December, for tax reporting purposes. You better be careful over there. If you choose a fiscal year end for your foundation, Form 990 PF is due 4.5 months after the end of the fiscal year. Seek advice. Filling out the Form 990 PF can charitably be called a nightmare. Chances are good that you won't ever prepare this return on your own, and neither will most professionals. Not to fear, some professional preparers do prepare these returns, but you may have to do some homework to find one. Don't just accept a preparer's word that he or she can do this work. Ask to see some evidence. Form 990 PF is open to public inspection, and you're well within your rights to ask to see one he or she has prepared. Warning. In these days of easy identity theft, be aware that Form 990 PF is a matter of public record and anyone can ask to see it. In fact, all Form 990 PFs are now available online at www.guidestar.org. Be sure when you're completing the return that you limit the amount of personal information you provide. You may want to use a business address and phone number, not just for yourself as trustee, but also for the foundation. If you don't have a business address, renting a post office box makes a great deal of sense. Oh, snap. All right. Owning Subchapter S shares in a trust. In a simple world, the only assets owned by the trust would be publicly traded stocks, bonds, and cash. But this isn't a simple world, and many grantors have less traditional sorts of property that they want to transfer into their trusts. One of these assets is often shares in the grantor owns. One of these assets is often shares the grantor owns in a small business corporation, commonly known as Subchapter S Corporation. In exchange for a significant tax break over larger C corporations, Subchapter S corporations are governed by rules limiting the number of shareholders, no more than 75, and who exactly may own shares. Trusts usually may not own shares, except for grantor trusts, where the grantor declares all trust income on his or her 1040 forms. Nice. That's cool. So when we start using the 98 foreign grantor trust, we'll be able to hold shares of stocks and that shit. All right, cool. However, if a trust instrument contains appropriate language and the IRS is notified in a timely manner, trusts may own S corporation shares. This section explains the options. Probably gonna have to go up for this one, right? Yup. Douchebag Noramus. Qualified Subchapter S Trusts, QSSTs. In a Subchapter S corporation, the shareholders, not the corporation, pay the income tax on the income the corporation earns. The corporate income tax return Form 1120S, U.S. income tax return for an S corporation, shows all the income for the year, and then splits it among all the shareholders on a Schedule K-1. Each shareholder then declares his or her portion of the income on 1040. Because trusts in general don't fall under the list of approved shareholders, if a trust wants to become a qualified shareholder, it must be certain to pass all of the income out to its income beneficiary. Welcome to the world of qualified Subchapter S trusts, or QSSTs. Remember, in order for a trust to be a QSST, it must meet the following conditions. The Subchapter S income must be distributed 100% to the trust income beneficiary, because that income must be declared on individual tax returns, not on trust tax returns. So in order for a trust to own S shares, it must pay out all its income to its income beneficiary. Or, if the trust is a grantor trust and doesn't have a separate tax return, the grantor declares all items of income on his or her 1040. A QSST may only have one income beneficiary, who must be a U.S. citizen or resident during the lifetime of that beneficiary. If the trust beneficiary is a non-residential alien, citizen of another country who doesn't live in the U.S., or a corporation, that trust can't be a QSST. Okay, so we're automatically out. One trust instrument may create multiple QSSTs. If a trust instrument creates these so-called separate shares, each of the shares may qualify as a Subchapter S shareholder, provided, of course, that the mandatory income beneficiaries fulfill the other requirements for S shareholders. If only it were as easy as knowing what the trust and the beneficiary are, as knowing that the trust and the beneficiary are qualified S shareholders. Unfortunately, you have to let the IRS know. Seek some advice sooner rather than later from a qualified professional, attorney, CPA, or enrolled agent, to make sure that the QSST election is filed on time, typically 2.5 months after the S corporation's year end. Failure to file these elections jeopardizes not only the trust election, but also the entire S corporation's existence as an S corporation. Remember, an S corporation that has even one disqualified shareholder stands to lose its S designation, leaving it liable for double taxation, first on corporation income, and then on the dividends paid to the shareholders. Oh, what happened there? Yo. That was fucked up. Apologies for that, guys. I don't know how that scrolled down like that. Oh, probably my book hit the number buttons. My bad. Fucking keyboard. Electing small business trusts, ESBTs. Although QSSTs must have one mandatory income beneficiary who is a U.S. citizen or resident, see the preceding section. Electing small business trusts, ESBTs, may have multiple income beneficiaries, and the trust doesn't have to distribute all the income. Instead, an ESBT, the following in an ESBT, the following apply. All beneficiaries must be individuals, estates, or charitable organizations. The S stock may not be purchased by the trust. The trust may not be a QSST or a tax-exempt trust. Each potential income beneficiary counts towards the total allowable number of the shareholders any S corporation may have. In an ESBT, the trustee, not the beneficiary, makes the election, notifying the IRS where the corporation files its tax returns of the name, address, and the TIN for each of the trust beneficiary. Usually, you must file an ESBT elections within 2.5 months of the corporation's year end. Seek advice. Like QSSTs, ESBTs are tricky beasts, best not attempted on your own, at least while you're getting going. Making a mistake here jeopardizes not only the status of the trust election, but also the corporation's S election. And if you think messing up a trust tax return is bad, just wait until you have a bunch of angry former S shareholders hunting you down because you now have to pay more taxes because they have to pay more taxes due to your error. All right. We'll scroll down here to where we were. We need to get to. So we're going to take a break there because that's the end of chapter 3. So anybody needs to get up, move around, whatever. We're going to take 5 minutes. I'm going to call for some food. And that I don't really have the money for, but I don't feel like cooking. Don't really have the time to cook, and I'm fucking hungry. So if anybody wants to talk about what we just read or has any insight on what we just read, I was so busy reading, I wasn't really thinking too much.
These recordings are great for reviewing, just like letting it sink in.
Yeah, absolutely. I gotta get some more water.
Hey, did you get the munchies?
Damn right I got the munchies. I had the munchies before I even started, but I didn't want to order food and mess around and have it get here like right as I was trying to read, which is probably what's going to end up happening this time around, but it's all right. Yeah, Blue, it's funny. I'm not even on my Wi-Fi right now. I'm plugged in. So that's how I know that they're fucking with my connection because I'm not even on Wi-Fi. But thanks for the message and the heads up. Here I was turning my volume on my phone off so that I couldn't hear anything because it was interrupting when I was reading, but I guess I need it for when this thing freezes because apparently they're going to continue to do this, so. Oh, well, that's weird. Got 14 messages and 14 notifications. What's the weather like where everybody's at? Right now, I got a ton of beautiful sunshine blasting through my big-ass windows.
Sun and snow.
Where are you at, Marie?
Indianapolis, Indiana.
Nice, nice.
Whopping 43 and sunny. Our snow melted.
Where are you at?
Illinois.
Yep. I'm in Maine. It's 40s, 42, 43. Snow's going away. Got to take my bearded dragon outside for the first time in months. She loved it.
I don't know if you can hear me. Arizona, pretty sunny right now. It's about 79, 80 degrees over here. I'm at the airport going ramp.
Thanks. We needed to hear that.
See, I'm from Arizona, too. That kind of makes me mad. Now I'm homesick. It's all good, though. Blue, why don't you hop on the mic, man? Say hi to everybody. You've been at a couple of these, and we haven't even heard from you. Might not be able to, though. I didn't think about that.
So, John, you said you and your uncle or somebody has a trust?
Yeah, my uncle and I, we both have completed our trust paperwork to take back ownership of the legal name. And so now the whole point is to try and
Hey,
learn
did
how to.
you create a silver bond with that?
We did a private registered bond. It did say payable. Hang on a second. I'll grab my paperwork.
Where'd you get an example of it?
I went through Sovereign Filing Solutions, makefreedom.com. They have a pre-prepared setup that's basically pulled directly from the redemption books. So let me see here. Yep, 100 million US dollars, which would be units of silver.
Nice.
And so that I filed my trust paperwork in 2016. So all of my stuff is cured. And is ready for dispersal. I just gotta figure out how. So we're there. You know, people are getting there. It's, you know, I like to say we always forget, but slow progress is still progress. If I did one thing today that put me further towards my goal, then even if it wasn't all I wanted to do, I can at least like put my head down at the end of the day and say that, you know, hey, I accomplished what I could, even if it was
That's
small.
right.
Hey, did you do any kind of paperwork when you set up for your estate EIN?
I used, so, all right. They hook you up with, let me go through my docs. Hang on. Let me finish ordering my food first.
You're frozen, by the way. Oh, not.
No, I wasn't frozen. I was just ordering my food. Almost done. All right. All right. What was your question again?
Who had a question?
So what kind of trust did you set up?
I set up an irrevocable.
Sorry, that was me. I'm at the airport, so every now and then I'm around a lot of noisy machinery belts, so I kind of mute out that way. It's not too crazy in you guys' ears. Um, that was me. I was asking about the estate EIN. If you filed or did any kind of paperwork for the estate EIN, similar to like what you're doing with the trust and found paperwork with the trust.
That is, so this trust paperwork, this is what you need to do to be able to have an estate EIN. Because your estate EIN is your 8.2 or 8.3, right? You have to have your trust in place to get that EIN. Then once you've got that, you get the 9.8 EIN. Once you've got
so you're saying you're creating the trust, but you're setting it up as the estate. But then once you have it set up as the estate, you get the foreign EIN. And then you said something about
once you get
it or
yes,
changing it into. Go ahead, sorry.
Once you get the foreign EIN, the 9.8 EIN, you take a form 8832, and you take the form 8832. You bring your social security number into the 8283.
Okay.
And then you take another 8832 and you bring your 8283 into the 98. Hang on a second. Have you been in there this whole time scratching? Is that what it was? I thought it was Dernovere, and I had you locked in the bathroom this whole time. I'm sorry, Mika. My bad, baby girl. My bad. All right. I need to take another hit. I'm not stoned enough yet. Any other questions about the trust?
John, can you hear me?
Yes, sir.
Okay, so let's break it down a little bit more because someone asked what trust that you created.
Yes.
Now, the trust that you created is your irrevocable trust. Is that your main trust that you're going to turn around and put when you talked about putting the EINs
Yes.
under that trust? Now,
Yes.
are those EIN other trusts that you're putting under this trust? So they're your irrevocable trust is your umbrella trust?
Yes. Your irrevocable trust is your original trust. This is the trust that takes control of your straw man. This is the trust that puts people on
anybody
notice.
Else hearing?
Can you hear me?
I can barely hear you, and my volume's turned all the way up.
I hear.
How about now? Sound any better? I can't adjust my mic volume, so.
You're good to me.
All right. So you don't really have to do an irrevocable trust for your main trust, but it's smarter. For the reason stated in there is the fact that you give up all rights and title to the property and it all goes in trust. So you can't have any liability for anything because it's the trust holds all the liability. If you retained right and title, then you also retain liability. And the whole idea is own nothing, control everything. So you want to have everything in a trust that's going to assume all of that control, and that would be the irrevocable.
Thank you.
Mm-hmm. So my advice to everybody, and this isn't me being like I don't work for these guys or anything. I like to approach things in a manner that gets the fastest and yet also most solid results possible. And going through sovereign filing solutions is one hell of a solid trust. Could you get better at understanding contract law and you win? I've heard it's debatable for the $2,000 that you spend. I know that makefreedom.com, aka Sovereign Filing Solutions, cost us it was $150 per person for us to file it ourselves. And then they gave us a discount for doing more than one person at a time. Everything was fast, like super fast. The thing that took the longest was the fact that we spent a lot of time reading, rereading, and overthinking our paperwork. I would say probably we got all of our paperwork in February and March. We didn't file till end of February, beginning of early March. We didn't file anything and have anything put through until April. And then we were approved by May. Everything was up on the UCC website by November of that year. And it's the kicker for me is I love their where is it? I got it right here. The legal notice and demand. This thing is fire. I'm thinking about, because it's written in such a way, I might be able to use it as my affidavit to get my state national passport. I was reading it, and it pretty much pulls you out. It's an affidavit that more or less pulls you out of the vessel in commerce, and it does it in a way. So like this is the one thing that we forget as secured party creditors, right? We think we're supposed to be going and filing motions. You don't file motions. You don't follow typical procedure. You file notices and demands. That's it. Because they work for you. You tell them. And this one's a good one. What I can do is, and it depends on the response I get of how fast I could get it done. I have a John Doe copy of everything that I filed, complete with bonds and everything. So you can look it over yourself and decide if you want to contact these people. But I'll tell you, if you're in this and you're stuck, it's a good way to get you over that hump and get you secured. And that's the most important part, is get secured. Everything else is amendments. So,
Hey, what's the use of the silver bonds that people create with 21 pieces of silver, whether it's a mortgage or a silver certificate dollars? Is it just for when they create other trusts underneath?
there's a lot of different uses for those. Whoa. Major feedback.
I've heard they use it for car insurance too.
Yeah, you can use it for car insurance. You can use it for personal liability insurance. You can use it for medical insurance. You can use it. You could flip it once you get far enough into this and you become and you've got your TDA account open and you can start trading in securities. You can flip that bitch. I'm not sure of the exact process, but it stands to reason. You turn around, you can sell your birth certificate and your name and your signature. Why not? It's a bond like anything else. Somebody's got to monetize it.
What was the cure time for the trust?
Cure time for the bonds, any bond, I think, is 3 months.
90 days, yeah.
Yeah. So, and, everybody received my bonds. Nobody returned anything back. as you know, that's what we come to expect: silence, acquiescence, all that good stuff. So, let me get some more water. Mika. Say hi to my dog, guys. This is Mika. Hi, Mika. Say hi, Mika.
Oh, that's cute.
Say hi, Mika. Mika, here. Wow. All right, get down. Give me your attention. All right. What time is it? 6? Wow, 6:30. Are you guys down to keep going through another chapter? I don't know. Here, let me see how many. It's not as long as the last one.
I'm here.
You got 2.
I am.
Okay. And then that'll get us through the first part of the book. That brings us to part 2, which is pretty fucking exciting, to be honest.
I didn't get the first one. Do you have them links posted someplace?
Yeah, they're up. They're up in the estate and trust
Videos?
book club.
Yeah.
The files are also uploaded. Those got put up today, so you have all of these photos that I've put up. You'll probably have to fix the order because somehow that got fucked up. Sorry about that. Also, the UCC workbook is up, so please feel free to grab that. I'm going to be working on getting the secured transaction video and the UCC workbook video, and hopefully this video up tonight. I may not be able to get all 3 up tonight because it takes a while. It takes a couple of hours to process, but I'm gonna try. So yeah.
Thank you.
Yeah, no problem. I mean, somebody's got to do it, and you know,
You are appreciated.
there are so many people that don't have access to these books, and the whole time that I was like studying this stuff in the beginning, I had to get crafty, and I did a lot of torrenting to get my files. I did a lot of illegal downloading to get my files. That was how I had access to any books at all, the Black's Law Dictionary, any of it. And slowly, one book at a time, and just taking my time and spending the money, I finally got my hands on some. And I did it too when I didn't really have the money to spend. I sacrificed in areas I really shouldn't have to pull it off. But if we don't take the risk, there's no reward. So I think my delivery driver's here. Hang on. Damn, what was the time on that? I don't think that was even 15 minutes from the time I placed the order to the time it got here. That's fire. You know, this pizza's gonna be hot too. My bad, y'all. I gotta get one little piece in me.
That book said the name of the next chapter was Administer in this Trust. One more time. I didn't see it. It was blurred. Okay. Thank you. Otherwise being the trustee or the representative. Otherwise being the representative in the public and the trustee in the private when you're administering the state.
Right. You always want to be authorized representative when you're in court.
Right.
Because you want to make the court trustee. You want to make everybody in that court trustee. Right?
Well, that's in the signature in general, right?
What's that?
That's signing the signature in general, right?
Yes, but you want the protection of letting them know that you know. So file a Form 56 on everybody. So, and this,
yes, sir.
So, okay, but again, I'm a student at this, just like everybody else. So don't take my word as God. You know, I've got good people that I've learned from, you know, big hitters in the game that I've studied, like I'm sure everybody else here has, you know, but we're all on this quest. Nobody's really completely got there, except for maybe a couple, and they're not readily available at the moment in the game. So,
well, brother, you know, the reason I ask questions is because there's new people and will continue to be new people on your show.
Yeah.
And
absolutely.
A little bit more elaboration. I know you know the answer, but they don't know the answer. And a little bit more elaboration gives them the benefit of the doubt, and they ask questions, so that keeps us on our toes, right?
True. But I do want to say to everybody, don't take my word for it. Research for yourself, please. I got to this point from trial and error. I filed my UCC 1 3 times and failed. Before I finally ended up taking the route of going to Sovereign Filing Solutions. And while I didn't prepare the documents, what I will tell you is a good chunk of my education was perfected in the filing and reading of these documents, because they're written in a way that gives no room for error.
Well, you must do your own research, because what works for you might not work for the next person.
Mm-hmm.
That's why you must do your own research and get your own.
Because everybody's situation is different. The one common thread and the one thing that works with these guys is that their main service is all about just getting you secured. After that, they really tell you it's on you. They tell you got to do the research, you got to do the homework. They provide you with a couple of resources of, different websites where you can reach out to people. But aside from that, they'll have like a couple of extra services. Like they at one point they were doing tort claims. I don't know if they're still doing it. I got to go on that site. I haven't been on them for a while. They will do the UCC 3 amendment, teaching you how to add your children to it, yada yada, for perfection of the lien. But yeah. So all right. Without further ado, my pizza's getting cold, so let's get through this. Chapter 4. Assembling your team members and knowing when to use them. Now, this is key. One of the biggest things in the Matrix was having a crew. And it's all about admiralty. It's all about law of the sea. So these roads is the rivers, the banks are the corners and the courts, So unless you're over here in Maine where they put a fucking bank on a roundabout, the corner of a roundabout, how the fuck does that work? All right. In this chapter, identifying what you can and can't do yourself, locating an attorney, fuck attorneys, assessing accountants, finding other experts and assistants, considering the facts about malpractice. The universe of trusts and estate is quite unlike any other and has its own set of rules and conventions that may seem completely foreign. In the fiduciary, trust and estate cosmos, accounting rules are different, and so are many tax laws. Navigating these new waters by yourself isn't impossible, but it's also not uncommon to want expert advice and assistance along the way. In this chapter, we'll tell you about different types of advisors you may want to consult, from attorneys to accountants to investment advisors, appraisers, and other assorted professionals. Finding what you need to go it alone. We both know lots of people who have successfully maneuvered their way through the world of estate or trust administration unassisted. Many of these were folks whose professional lives touched on this area, so they had some idea of where to start and how to proceed. We also know plenty of others whom we met midway through the administration process, after the executor, administrator, or trustee finally threw up his hands in defeat. Remember, you can find a middle ground. Administering a trust or estate without professional help is entirely possible, but you shouldn't assume that you'll be able to do it without doing some homework. The fact that you're reading this book get the mouse in the right spot. I didn't even know. Blue, to answer your question, I went to makefreedom.com, also known as Sovereign Filing Solutions. They do the paperwork up for you, email it to you, you print it, take it out, have it notarized and whatnot, and mail it off yourself. You do have to go through and add your information, so you're forced to kind of read a little bit, even if you don't want to. But I suggest you do. I suggest you read every inch of that freaking set of documents 3, 4, 5, 6 times. Read it once and put it on record and then fucking listen to it in your sleep. Seriously. And make sure you make more than 5 copies of everything. I would do at least 5 or 6 copies of everything, just to keep for your own personal self, and put your originals in a safety deposit box or in a safe that you have at home somewhere, and don't carry them on you. Keep your originals and get them notified or notarized as certified copies. And keep your documents on you. If you got to carry a briefcase, if you got to carry a backpack, you need to keep your documents on you, because you don't need ID anymore. Really, in all actuality, you don't need ID anymore. All you need is your trust documents and your UCC1 and all that shit. Especially when getting pulled over, you should only have your trust documents and silver bullion. Nothing, no state ID, none of that stuff. Anything that could construe you as a U.S. citizen needs to be gone, and make sure that you have silver bullion in your pocket. That's your get out of jail free card if they decide to haul you in, because they can't process silver. All right, where was I? The fact that you're reading this book is a great starting point, but we'd be remiss if we didn't point you to some other resources as well. IRS Publication 559, Survivors, Executors, and Administrators. All right, everybody you can take notes, but you're going to get this anyway, but this is stuff you might want to enact, like start looking up right now. IRS Publication 559, Survivors, Executors, and Administrators. Although reading this publication may not be your idea of a good time, it is a key resource and highlights the important issues you need to be aware of. It gives you tax advice for the deceased person's final 1040, the estate trusts, the estates or trust form 1041, and the estates form 706. Every time I read this, I think about Dragon Ball Z and Frieza saying, "This isn't even my final form." Nerds that are into comic books and anime will know what I mean, but people in here probably have no clue. Anyway, it's funny. It also gives general administration advice, comprehensive income tax return examples, and a valuable checklist of forms and due dates. Instructions for tax returns. We'd love to say that we never read the tax forms instructions, but we'd be lying. They seem dense and intimidating, especially if you're not sure where to look. Fortunately, most give instructions line by line, and very often terms and concepts are introduced either at the beginning of the instructions or at the start of the particular chapter within the instructions. If you're afraid of losing the information after you've located it, make a photocopy of the appropriate page, highlight the pertinent text, and keep it together with your copy of the return and any supporting documents. Your local probate court, or its equivalent in your state. In addition to being the best place to locate all the probate forms you need, most courts also have pamphlets available that explain the probate process in your locale. Making friends with clerks or assistant registrars at the probate court never hurts. Many of them have been there longer than the furniture, and what they don't know about the probate probably isn't worth knowing. What they don't know about the probate isn't probably worth knowing. Your state Department of Taxation or Revenue. Every state has specific requirements for trusts and estates, and many have publications available to help guide you through the process. In addition, if you have questions, call the state tax department and ask to be transferred to the fiduciary or trust and estate section. Every state tax department has at least one person in that area. Make sure that you get her contact info and keep it handy. A little sexist with that remark, huh? Couldn't be a guy, huh? If you run into trouble down the road, Having a person who is familiar with your situation is invaluable. Warning. We don't suggest that you ever phone the IRS for fiduciary tax advice. The IRS doesn't focus its training on fiduciary tax, and its telephone support is spotty at best. What's worst, you don't know whether the person on the other end of the phone actually knows what she is talking about. If you can't find the answer you're looking for in writing, you may want to ask the question of a private practice tax expert who specializes in trust and estate returns. She may be willing to answer your questions for free if it's a simple one, or at least point you in the right direction. See the section Hiring a Tax Professional later in this chapter. Shit, I need to scroll down. Finding an attorney. If the prospect of estate or trust administration leaves you cold, or you've already begun delving into the administration and realize that you're in over your head, you may want to consider hiring an attorney to either shepherd the process from the beginning to end or to help you with only certain aspects of the administration. For example, you may want help with the probate process and with preparation of the estate and income tax returns, but you feel you should be the one to go through the house and figure out what the decedent owned. Even doing this much yourself can save you a pretty penny in fees, and the experts are usually happy to have you do as much fact gathering as possible. Tip: whatever the extent of the work you want an attorney to perform, finding the one you can work with for a reasonable fee isn't impossible. Before you start, though, make sure that you have some idea of the scope of the work that you want the attorney to undertake for you. A common pitfall in estate and trust administration is not having a grasp of who is responsible for what duties. Although any attorney worth his weight will have a comprehensive things to do list that covers most scenarios, the only sure thing about estates and trusts is that no two estates or trusts are alike. When working with an attorney, or any professional for that matter, make sure that everyone knows what they're supposed to be doing and every job is covered. Nothing should ever fall through the cracks. The following sections can help you not only locate an attorney, but also choose one after careful investigation. After you hire an attorney, you also need to know how to pay him, so we cover payment options as well. Knowing where to look. When searching for an attorney to help you with your estate or trust, you may be wondering, where's the best place to look? Unfortunately, you can't rub a magic lamp and ask an attorney to appear, but you can do some investigative work on your own to uncover what's a good match for you. Check out the following resources when searching for an attorney. Phone directory or search engine. I'm not even going to read the long-winded shit on that. Martindale-Hubbell. Sorry. Because, I mean, if you can't put together what that means using a search engine, come on now. Martindale-Hubbell. This database lists most lawyers in the United States as well as many of those in foreign countries. We're not sure that we'd consider using an attorney who wasn't listed in the Martindale-Hubbell. You can find attorneys all over the country by using their free website, martindale.com. Not only can you search for attorneys and law firms by practice type, and the practice type you want is either trusts and estates or wills and probate, and location, but you can also check out peer rankings, other attorneys' opinions of this attorney's expertise. A rating of CV is very good. BV is even better, and AV means the attorney is one of the greats in that area. Local, county, and state bar associations. Bar associations all have lawyer referral services which match you with your, you know what, I feel like we shouldn't even be reading this because we all know we're not going to use an attorney. But I'll spit it out anyway. Bar associations all have lawyer referral services, which match you with an attorney in your region whose law practice focuses on the area you request. Referrals are free and made on a rotating basis. Your first half-hour appointment with the attorney is typically billed at a much reduced rate. Personal references. You may already know someone who's been in charge of someone's estate or trust, but you're just not aware of it. Ask people you trust where you work, within your family, or at your place of practice, or at your place of worship. If they've personally worked with an attorney or an estate or trust that matters, or with an attorney on estate or trust matters, good Lord, I'm butchering shit, and whether they were satisfied with their service received. Referrals from the professionals or within law firms. You may already be working with a tax pro or an investment advisor who may have the name of an attorney whom they know to be competent and reasonable. Or you may have a client of a large firm that practices in many areas, even if the attorney you usually employ doesn't do trust and estate work. Generally, referrals come from other professionals are good ones. After all, the professional reputation of the person who makes the referral is as much on the line as that of the person being recommended. Referring to a non-qualified person doesn't benefit anyone. Tip: in order to double-check an attorney's credentials, check out the following: his law firm's website. Before you actually speak to him, visit the firm's website. Often websites include abbreviated resumes, lists of articles written, or professional and charitable organizations the attorney is involved with. Because you may find yourself working closely with this person for a period of months or years, this relationship is an important one. The more info you can gather up front, the happier you may be with your final selection. Your state's licensing and oversight agency for attorneys, particularly if the attorney you select isn't personally known to you or someone you trust, you can check with the Board of Bar Overseers or the like to make sure the attorney hasn't had any complaints of malpractice. Or malpractice suits filed against him, or at least none with any merit. You can consider overlooking nuisance lawsuits, but you would want these explained away very thoroughly. Asking the right questions. Finding a competent attorney is only the first step in crafting an effective partnership between you as the executor, administrator, or trustee and your new attorney. Now you must establish lines of communication and determine whether you and this attorney are compatible. Although working with an attorney isn't really like a marriage, two people with completely different work styles and ethics will be sure to rub each other the wrong way. Before you get too involved with the whole administration process, you may want to interview the attorney to get a sense of whether you'll be able to work efficiently with this person. Among the questions you may want to ask are, how much experience do you have in administering trusts or estates? How often do you check in with your clients? How long does it typically take for you to respond to requests from clients? Who actually performs the work? You or a paralegal, trust or estate administrator, or legal secretary? Of course, if the subordinate is actually preparing the work, with the advisor simply reviewing it and being ultimately responsible for it, the arrangement can be very cost-effective for you because the hourly rates for junior staff members are always lower than those for more senior attorneys. How do you prefer to communicate with clients? Via phone, written correspondence, email, or in person? What are your privacy policies? Remember, after you have the answers to these and whatever other questions you may come up with, you can be fully prepared to decide whether you hire this attorney or not. If you choose to, great, your search is over. If you find the little hairs on the back of your neck to stand at attention, though, you may want to continue looking. You probably kissed a lot of frogs before you met your life partner. This choice, although not the stuff of dreams, the stuff dreams are made of, can turn into a nightmare if the attorney you hire is actually a toad. And remember, if you decide at a later date that the attorney you've chosen is no longer someone you'd want to bring home to meet your family, you can change. An estate or trust attorney works for you, the executor or trustee, and not for the estate or the trust. If you're not happy, keep searching until you find the right person. Longer than I thought. Discussing payment options. One of the biggest questions, and one that most attorneys are very happy to discuss, is the manner and size of the payment. Attorneys involved in estates may charge fees in one of three ways. Plus, they all charge for miscellaneous disbursements, which are almost always additional. Hourly fee, the most common type of fee arrangement. Attorneys bill you for the number of hours or partial hours they spend on your estate or trust. They'll tell you upfront how much they charge per hour. Don't be shocked at some of the numbers you'll hear. Didn't switch pages, did I? I did not.
That's fine. Let's see. What's going on, guys? Can you see me?
Cannot. Who's that? Is that Zeal?
Yeah.
No, we don't got you, Zeal.
Oh, that sucks. The hell?
So,
Did I do something wrong again?
no, just turn your camera on. There you go. We got you now.
Be smarter than the technology, right?
There you go.
Yeah, sorry I'm just not joining. I had to take care of my my 7-month-old. She actually fell out the crib head first, and I caught her. Yeah, I caught her by the foot at the last second. She hit her head, so yeah, that was my first concern.
All right.
You know, everything else is secondary.
Is she okay?
Yeah, she has a bottle. She's asleep right now, so I'm keeping a close watch on her. You know, my wife went out with her sister and our oldest son to go skating because he's been somewhat good. So I got her and I got my other 3 running around. So I'm trying to pay attention to everything while trying to clean up, you know, do laundry, folding clothes and all that. Yeah. Who say parenting was easy, right?
Yeah, nobody.
Man. So,
all right.
But yeah, so what's going on, man? Let's talk.
We're just reading.
Oh, okay. Let me get back to what you guys what's that? Let me see if I can blow this up. Blow this up? Oh, okay, yeah, I can blow it up. Let's see what we got.
All right, where were they? Don't be shocked at some of the numbers you'll hear, some of which now exceed $1,000 per hour in major cities. Remember, high hourly rates don't always equate to the best legal help money can buy. Large firms charge more because their overhead is greater, and single practitioners who hang out their shingles in the town square charge less. Keep in mind, though, that the overall fees charged by the large firm are often comparable to those of the single practitioner because the large firm has staff such as trust and estate administrators who actually perform the bulk of the work. These estate and trust experts work under supervision of an attorney, but their hourly rates are much lower. Attorneys bill hourly fee arrangements periodically, sometimes as often as monthly. Flat fee, usually calculated as a percentage of the value of the estate. If the attorney manages to efficiently administer the estate, you know in advance how much the fee is. The attorney usually walks away very happy. Flat fees are normally paid on a schedule or in partial payments whenever the attorney bills you. This sort of fee arrangement is the most common in small to medium-sized estates rather than larger estates, because not only the probate court but also the IRS must approve the fee of the fees an estate attorney charges if an estate tax return is filed. Ayo, Zeal, I got a question for you. Can you read the book up on the screen? Like, can you see it well enough to read it?
Let me blow it up a little bit. Okay. Yes. Was it contingency fee? Is that where you're at?
Yep.
Okay.
Would you mind reading for a bit so I can just get some food in me and let my voice relax because my throat's starting to hurt?
Not a problem. Hold on one second. Millie, put that down. I'm on the phone, Pumpkin. I'll deal with you in a minute. Okay, let Daddy do some stuff. All right. Although rare in the world of trusts and estates, in certain circumstances, an attorney may accept an estate on a contingency fee basis or a percentage of the amount collected by the estate. If a trust or estate is suing another party in a lawsuit and stands to potentially receive a substantial cash award in the future. A lawyer may agree to represent represent it, and you as fiduciary, all right, in exchange for the chance, for the chance of receiving a hefty piece of that reward. Okay, miscellaneous oh man, I'll blow that up a little bit. Come on, blow up. Disbursements. All right. No discussion of attorney fees. See, incomplete without alerting you to the fact that all the attorney fees covers is her time. Everything else is extra. I didn't know that. Except an itemized breakdown or every invoice of the things like postage, photocopying, delivery services, filing fees, and even the sandwich you ate when you met the attorney for a lunchtime conference. Interesting. All right, up to the top. Fees aren't typically negotiable. An attorney presents you with her terms before you decide to do business. You can usually ask an attorney who normally charges a flat fee to bill you on an hourly basis. But those who charge hourly are on a oh, come on, blow up again. Stop doing that. Blow up. Dang it. I'm sorry, guys. My screen is acting up on me. Give me 1 second. Okay, but those who charge hourly or on a contingency basis probably won't change, although you may convince one to give you some sort of discount. Perhaps you're friends with her great aunt. Even a discontinued rate will cost you plenty. If the attorney is doing everything the best and surest way to keep fees low is to do as much of the work as you can yourself. No, none of this. Finalizing your decision. Okay. Whether you meet with one attorney or with several, you'll eventually find one that fits your personality and wallet. Remember, your choice isn't irrevocable. No. I'm sorry, excuse me 1 second. No, put that down. Don't do that again. You may change attorneys at any time and for any reason. Unhappiness with your choice, even without professional misconduct or shady dealings, is a reason to try again. In order to formalize the arrangement between client and attorney, the attorney may require that you sign an engagement letter. What that is, outlining the scope of the work to be performed, and each of your responsibilities. For example, you may be responsible for providing the attorney with all relevant information. All relevant information filed. Generally, these letters are formulaic, but you should still take the time to read through them carefully. Anything you don't agree with can be crossed out and additions can be manually inserted, provided that both you and the attorney initial the charges. Ask questions if anything in the letter is unclear. After all, it's your descendants' money. All right. Working with your attorney. Hiring an attorney or other professional you like is only the first step. Now you have to work with him or her, and the success or failure of your new relationship rests on how responsive each of you is to the other. Good communication is the key. When you receive requests from info, you should try. No, stop. You should try to stop it. I'm on the phone. You should try to respond within a reasonable length of time. If you're not able to give him or her a complete answer reasonably quickly, you should make a phone call or send an email outlining whether you are in the process and how soon you anticipate having a complete answer.
All right, cool. Thank you, man. I appreciate your help.
Not a problem at all. I'm gonna put you guys down for made a super mess and I have got to clean it up.
Go have fun. All right, sorry about that, guys, but this pizza was just intoxicating me with the smell, and it was just throwing my whole head off. I was over here reading like, but pizza, reading, but pizza. All right, where were we here? Choosing where to look for a professional advisor. Strange as it may seem, looking in your hometown for the advisors you need to assist you in administrating a trust or estate may not be the best choice. Because the estate must go through probate in the county in which the decedent lived when he or she died, choosing an attorney or certified public accountant licensed in that state is usually best. That attorney or accountant will be up to date on all the specific rules for that state and will be able to more efficiently help you through whatever probate or tax issues you may have than an attorney or an accountant from a different state can. As a matter of fact, if the attorney will be appearing or filing documents in the probate court on your behalf, he or she must be licensed to practice law in that state. On occasion, the decedent will have owned property in more than one state, and probate must be established in each state where he or she owned real estate. In that case, your attorney may encourage you to hire attorneys in other jurisdictions. In fact, attorneys who specialize in estate and trust work often have reciprocal arrangements with other attorneys in states such as Florida and Arizona, where many people own second homes. If you're happy with the work your attorney is doing, odds are you'll also be happy with the services of someone he or she recommends. The location of your advisor makes no difference when your major concern is investing, although you do want to make certain that the advisor is aware of the estate's trust state of residence. This knowledge often affects the investments the advisor suggests to you. When probating an estate, be sure that any advisor you select is licensed to do business in the estate's state of domicile. Finally, if your expert choice is an enrolled agent or someone who is licensed by the U.S. Treasury specifically to deal with tax and tax-related issues, you may comfortably hire one from any estate in the country. Enrolled agents are licensed by the federal government, so they may practice in any other states, territories, possessions, or commonwealths of the United States. Hiring a tax professional. In the process of administering the estate or trust, you may find that the tax and accounting requirements are beyond what you're happy or comfortable doing. If this describes you, having a tax professional like a certified public accountant, CPA, or an enrolled agent, EA, on your team can help ensure that the trust or estate is always in compliance with tax and accounting rules. You're not alone. If you're not sure of the difference between the CPA and the eCPAs, you are qualified in all areas of public accounting, excluding taxation and auditing. EAs, on the other hand, specialize only in taxation. Because public accounting rules don't apply to the trusts or estates, both EAs and CPAs, if experienced in this type of work, can competently perform any of the accounting functions required, such as an account preparation or figuring out how much and what property will roll from the estate to the trust after the estate terminates and the trust assumes ownership of the decedent's assets. Whether you choose a CPA or an EA, both are subject to rigorous regulation and are required to participate annually in continuing education. Provided the person you choose has experience with trusts and or estates, either is well qualified to assist you. The next section can help you make the right choice. discovering where to look. Unlike looking for an attorney where you can search a database, no single place exists for finding CPAs or EAs. If you're searching for a CPA, you could check with the State Board of Accountancy in the state where you want to hire one, or with that state's CPA professional association. You can locate EAs through their national professional organization, the National Association of Enrolled Agents, the NAEA, or through their state regional organizations. In addition to assessing the state licensing boards and the state federal professional organizations, you may also request referrals from family, friends, and other professionals such as attorneys or investment advisors who may keep lists of CPAs and EAs with whom they've dealt with in the past. It's common practice for CPAs or EAs to have you sign an engagement letter when you hire them, which outlines the scope of the work to be done, who is responsible for obtaining the necessary information, and the level of review they will use to determine the accuracy of that information. Tip: hiring an accounting pro who will provide you with the services you need is really no different from hiring an attorney. You need to know what your work styles complement each other than that you won't drive each other nuts during the administration. You should ask any CPA or EA you're considering employing the same questions you ask the attorney. Check out the earlier sections asking the right questions. Don't hesitate to add any others you might think of. Where'd you go? I don't like you back there because I might sit on your tail. There you go. All right. Warning: not all tax return preparers are created equal, and this is especially true in the world of estates and trusts. Only attorneys, CPAs, and EAs are licensed to practice in front of the IRS. Other tax return preparers may say they have the expertise, but they haven't been tested and they have no requirements to stay up to date on current laws. Before you put your faith in your trust or estate tax returns in the hands of any preparer, carefully check their qualifications and their expertise. Discussing payment options. CPAs and EAs typically charge for their services based on the number of hours worked or the number and type of tax forms prepared. In the case of trust or estate, most bill on an hourly basis. Costs such as photocopying, postage, and deliveries are often additional. Although individual accountants may cover these incidental costs by charging slightly more per hour, accountants' hourly fees are usually less than attorneys, but they're still in the same ballpark. Be prepared. We don't want you to suffer from sticker shock. Tip: be sure to establish not only the hourly rate, but also what it includes prior to having a tax professional prepare any work for you. It's awful both for you and your accountant to have initially positive relationships sour upon receipt of the first bill, purely on the basis of a misunderstanding. Remember, accountants, like attorneys, often have subordinates perform many of the tasks you assign them, with Mr. or Mrs. Biggs supervising the project and retaining the responsibility for its timely and accurate completion. Remember, the employee who actually performs the work is probably quite expert. As an added bonus, because the person doing most of the project is charging you less per hour, this practice is much more economical for you. Oh, throat's getting sore. Considering help from other pros. Very often, executors, administrators, and trustees are thrust into situations for which they have no preparation and no experience. You may find yourself in this category as you attempt, for example, to dispose of Aunt Bess's doll collection, rent Uncle Sam's house, or invest Cousin Mercy's millions. Figuring out what you have, what its value is in the estate or trust, and maintaining that value is often a job for the experts. The following sections highlight a few other professionals you may need to help you fulfill your duties as the head of the estate or trust. Determining whether you need an investment advisor. Both of us are reasonably savvy investors with decades of experience in various investment strategies. We both can easily tell you the difference between stocks, bonds, and options. Despite our comfort with handling large sums of other people's money, we wouldn't hesitate to hire an investment advisor to advise us on investing estate, trusts, or funds. Estate or trust funds. Warning. The unfortunate reality is that in a world where corporations and individuals alike are sued for seemingly frivolous reasons, an executor or trustee who fails to act prudently to preserve the value of the assets is fair game for a lawsuit. If you're in charge of assets that require investing, you should protect yourself against charges that you accepted improperly. Hiring an investment advisor provides you with an insurance policy against such accusations. Doing it yourself at your own risk. Perhaps you're leaning towards investing money yourself. Maybe you assume that no one else will want the bother of managing the small pot of money you have to invest. But do you even know if you have enough assets to bother with the expense of an investment advisor? If you have $600,000 or less, you may choose to use a full-service broker. He can advise you for the cost of the commissions he makes on each stock or bond purchase and sale. Or you may opt to invest in mutual funds, which are invested by a professional money manager, bypassing the need for a separate investment advisor for larger amounts. Or if you want to invest only in individual securities, you may want to hire a reputable advisor whom you trust. In making this decision, keep in mind that unlike the trust assets, which may be there for the long haul, estate assets are held there for a relatively short time. Because your duty as executor is to preserve, not grow the estate, your investment decisions may be quite simple if your goal is to distribute the estate outright to the beneficiaries upon the termination instead of communicating it in trust. See Chapter 7 for more on making the decision on whether to sell assets to protect against your liability. Going with an investment advisor. If you want to go with a professional to help you invest the money, you have a few options. However, unlike an attorney, CPA, or EA, who must be credentialed either by a state or federal government in order to practice, an investment advisor doesn't have to have any specific credentials. Among the professionals who offer financial advice are the following: certified financial planners, licensed by a Certified Financial Planner Board of Standards. These individuals have completed extensive additional education in addition to their bachelor's degree. Attorneys, CPAs, or EAs. Their training isn't specifically in investments, but many of them have become quite the expert in this area because of the nature of their practice. They don't assume that every attorney or tax professional is qualified to also act as your investment advisor, but don't rule out the possibility either. Stockbrokers. Full-service brokers not only purchase and sell securities for you, but also research the companies they recommend. Stockbrokers must have passed the Series 7 exam in order to qualify. Remember, an online or discount broker does not provide investment advice. He merely places the trades upon your instructions. Remember, I didn't scroll, my bad. Went through a whole page and y'all didn't even tell me. Y'all slipping. Went through a whole page and you didn't even tell me.
I'm using my paper book.
Oh, you suck.
And I'm reading out loud with you.
Are you really? Well, why don't you take over for a minute then? Because my voice hurts. My throat's really hurting. I would really appreciate it. Here's my nice guy smile. No? All right.
Wait, where exactly are we?
I don't know. Where were we?
Discussing payment options. Did you just get started and did you turn the page or not? I'll just start there, okay?
Yeah, that works for me. Discussing payment options, and I'll scroll back up so that it leads over.
Okay, discussing payment options. CPAs and EAs typically charge for their services based on the number of hours worked or the number and type of tax forms prepared. In the case of a trust or estate, most bill on an hourly basis. Costs such as photocopying, Postage and deliveries are often additional, although individual accountants may cover these incidental costs by charging slightly more per hour. Accountants' hourly fees are usually less than attorneys' fees, but they're still in the same ballpark. Be prepared. We don't want you to suffer from sticker shock. Be sure to establish not only the hourly rate, but also what it includes prior to having a tax professional prepare any work for you. It's awful, both for you and your accountant, to have an initially positive relationship sour upon receipt of that first bill, purely on the basis of a misunderstanding. Accountants, like attorneys, often have subordinates perform many of the tasks you assign to them, with Mr. or Ms. Big supervising the project and retaining the responsibility for its timely and accurate completion. Remember, the employee who actually performs the work is probably quite expert. As an added bonus, because the person doing most of the project is charging you less per hour, this practice is much more economical for you. Considering help from other pros. Very often, executors, administrators, and trustees are thrust into situations for which they have no preparation and no experience. You may find yourself in this category as you attempt, for example, to dispose of Auntie Bessie's doll collection, rent Uncle Sam's house, or invest Cousin Mercy's millions. Figuring out what you have, what its value is in the estate or trust, and maintaining that value is often a job for the experts. The following sections highlight a few other professionals you may need to help you fulfill your duties as head of the estate or trust. Determining whether you need an investment advisor. Both of us are reasonably savvy investors with decades of experience in various investment strategies. We both can easily tell you the difference between stocks, bonds, and options. Despite our comfort with handling large sums of other people's money, we wouldn't hesitate to hire an investment advisor to advise us on investing in estate or trust funds. It seems like we just read that. That's weird. The unfortunate reality is that in a world where corporations and individuals alike are sued for seemingly frivolous reasons, an executor or trustee who fails to act prudently to preserve the value of the assets is fair game for a lawsuit. If you're in charge of assets that require investing, you should protect yourself against charges that you acted improperly. Hiring an investment advisor provides you with an insurance policy against such accusations. We just read that. What's going on? Did I start wrong?
Yeah, you started a little early, but I figured that that was the page that I read that wasn't on screen, so I figured let it ride.
Oh, okay. Great. Okay. Doing it yourself at your own risk. Perhaps you're leaning toward investing the money yourself. Maybe you assume that no one will want to bother of managing the small pot of money you have to invest. But how do you even know if you have enough assets to bother with the expense of an investment advisor? If you have $600,000 or less, you may choose to use a full-service broker. He can advise you for the cost of the commission he makes on each stock or bond purchase and sale, or you may opt to invest in mutual funds, which are invested by a professional money manager, bypassing the need for a separate investment advisor. For larger amounts, or if you want to invest only in individual securities, you may want to hire a reputable advisor whom you trust. In making this decision, keep in mind that, unlike the trust assets, which may be in there for the long haul, estate assets are held for a relatively short time. Because your duty as executor is to preserve, not grow, the estate, your investment decisions may be quite simple. If your goal is to distribute the estate outright to the beneficiaries upon its termination instead of continuing it in trust. See Chapter 7 for more on making the decision whether to sell assets to protect against your liability. Going with an investment advisor. If you want to go with a professional to help you invest the money, you have a few options. However, unlike an attorney, CPA, or EA, who must be credentialed either by the state or the federal government in order to practice, an investment advisor doesn't have to have any specific credentials. Among the professionals who offer financial advice are the following: certified financial planners, licensed by the Certified Financial Planner Board of Standards. These individuals have completed extensive additional education in addition to their bachelor's degree. Attorneys, CPAs, or EAs. Their training isn't specifically in investments, but many of them have become quite expert in this area because of the nature of their practice. Don't assume that every attorney or tax professional is qualified to also act as your investment advisor, but don't rule out the possibility either. Stockbrokers. Full-service brokers not only purchase and sell securities for you, but also research the companies they recommend. Stockbrokers must have passed the Series 7 exam in order to qualify. Remember, an online or discount broker doesn't provide investment advice. He merely places the trades upon your instructions. Knowing where to turn isn't always easy because no one size fits all. Be sure to ask questions, starting with those you asked when hiring an attorney or a tax advisor. Refer to those two applicable earlier sections, and add this important one. Could anyone else, like the insurance company the advisor works for example, benefit from the advisor's recommendations? If you don't like the answers or think the advisor is promising you the moon, in order to win your business, move on to the next name on your list. Like speed dating, if there's anything that makes you uneasy in the first few minutes of conversation, chances are good that this advisor isn't a good fit for you. Investment advisors expect to be paid for their expertise, but their fees sometimes seem excessive. When negotiating what you're willing to pay for these services, watch for certain warning signs. Commissions. Stockbrokers earn commissions each time they buy or sell stocks on your behalf. When stockbrokers have complete control of an investment account, they may churn the account, placing trades frequently with the sole intention of earning more commissions. This practice is strongly frowned on. If you think your broker is churning, look for frequent trades, especially in small numbers of shares. You should question the broker and advise his supervisor. Short-term investing in a trust or estate account to capture market fluctuations is a no-no, and you as a fiduciary shouldn't permit it. Don't forget it's always appropriate to review pre-death brokerage statements for churning, too. Fee service. This method is the safest way to pay for advice because you pay only for the time the advisor works on your investments. Of course, sometimes the bill may seem high to you if you suspect that your advisor is padding the number of hours he is billing you and you're not already receiving an itemized statement, which you may not have thought to ask for when you established this relationship. You should ask to see a breakdown of the charges, but if the advice you're receiving is good, you may sour the relationship with this advisor by questioning his charges. Percentage fees. You're most likely to see these fees from advisors who actively invest for you. You give them control of the investments based on a written understanding between you as to the type of investing you desire. The advisor charges quarterly fees based on two components: a percentage of the market value of the security portfolio and a percentage of income, interest, and dividends earned by that portfolio. You may negotiate the fees at the time you and the advisor are establishing the contract. If you feel the advisor's percentages are too high based on the portfolio size and how much work you believe will be involved, you can always ask for a low percentage. Remember, the advisor wants your business and his fees aren't set in stone. No one standard regulatory board oversees all investment advisors, although the SEC regulates many of them. So official monitoring can be spotty because they often have almost unfettered access to the trust or estate's assets. The potential for abuse can be high. Make sure that you obtain and check references before you hire an advisor, and don't shirk your responsibilities by assuming that the investments are in safe hands. Constantly review the advisor's work, asking questions when something doesn't make sense to you. Remember, someone else placed great trust in you and your judgment when they named you as fiduciary. Use that good judgment to figure out when something just doesn't smell right. Obtaining appraisers where necessary. In a perfect world, property would only enter trusts and estates as cash, as stocks and bonds, or as precious metals, the value of which is easy to determine and maintain. Unfortunately, trusts and estates rarely inhabit a simple world and often include other assets, like the house, the car, jewelry, rental real estate, early 20th century Japanese art, or a comic book stash. You, as executor or trustee, need to know what it's all worth. And although you may be able to rely on yard sale values or online auction sale prices for general household goods, you need to find a reputable appraiser for larger items like jewelry, artwork, and real estate. When searching for an appraiser, go first to the source. If you're holding Aunt Bertha's diamond ring and it's still in the jewelry jeweler's box with the name stamped on the cover, try to find that jeweler. You may still have the original documentation and will be able to prepare an official estimate of value without too much additional work. Likewise, real estate agents often have certified appraisers in their offices. Many both sell and appraise property. If you need to value a rare coin collection, go to the local rare coin dealer. In fact, people who sell specialized property are used to appraising, and it's typically one of the services they offer. Of course, some property is one of a kind, and appraisals for these items can be notoriously difficult to obtain. In the case of artwork by an artist who is still living, the gallery that represents his work should be able to provide you with a written appraisal. Auctioneers from top echelon auction houses can provide appraisals for artwork that from deceased artists as well as for antique furnishings. Occasionally, you'll run across singular pieces of art or furnishings that may require you to inquire of art museum curators. Appraisals are increasingly coming under IRS scrutiny. If you need to obtain an appraisal, make sure that the person appraising the property is an expert in that field. The appraiser will, as a rule, attach to the appraisal a resume or curriculum vitae showing his qualifications. If it's not attached to the official appraisal, ask for it. Should the IRS ever question the valuations you use on a Form 706, see Chapter 16. Appraisals jotted down on a piece of paper will not fly, but one that documents the value of the item in question and the qualifications of the appraiser most likely will. Consulting with other miscellaneous pros. Every estate and trust requires different levels and source of advice. Some additional professionals you may want to consult include business consultants. If an asset of the trust or estate is an operating business, don't be shy about finding someone to help you run it. Charitable advisors. If you are a trustee of a charitable foundation, reputable advisors can assist you in developing the foundation's charitable direction and show you how to identify charitable organizations you may want the foundation to contribute to. Doctors and other medical professionals. As a trustee, you're often charged with providing resources to guard the health and general well-being of trust beneficiaries. Sometimes you need to do more than just foot the bill. You actually have to make arrangements with various medical professionals for necessary services. Litigators. Even though you as fiduciary presumably already have an attorney, you may find you need representation in a lawsuit involving the estate or trust. Remember, the trust or estate's attorney isn't always experienced in litigation and in courtroom situations, and will probably refer you to a competent litigator in your area if you find yourself in this situation. He definitely won't be offended if you go elsewhere for representation, and in fact should applaud the move. Recognizing malpractice. Everyone makes mistakes. It's the nature of the error and what steps are taken to rectify it that determines whether or not you have a case of malpractice. Professional malpractice covers quite a bit of ground. Among the reasons you may claim malpractice are cases where a professional has been negligent, where a professional has acted unprofessionally according to the standards set by his or her peers, and where there is a fee dispute. We've seen many cases of malpractice over the course of our careers and cleaned up after a variety of attorneys, accountants, and investment advisors who not only messed up but left the mess sitting for the next person. What defines the malpractice is that not only was the mistake preventable and the cleanup expensive, but the estate or trust has to foot the cost. Malpractice can occur while you're administering the estate, but it also could have occurred during the decedent's lifetime, and you need to be on the lookout for potential malpractice when you first become executor or trustee. For instance, if the decedent's attorney didn't draft the will and or trust correctly with unintended results, that's malpractice. Although you may not have the professional expertise to know this type of malpractice when you see it, those professionals whom you hire hopefully will. Surveying why malpractice occurs. Malpractice happens for primarily two reasons: lack of knowledge and or oversight, and lack of ethics. The first, lack of knowledge or oversight, causes most mistakes. Unfortunately, ignorance of the law is no excuse. So an unwitting omission is still a mistake and it may still cost you. True professionals do everything in their power to make sure that you don't suffer for their mistakes. When an error is discovered, not only will a professional notify you of the problem, but he will also take steps to rectify it while limiting or even eliminating the cost to you. So, for example, an accountant who fails to file accurate income tax returns should pay for the penalties if the inaccuracy was due to his failure, and not the client's. On the other hand, it's reasonable to expect the client to pay the additional tax and interest, as the tax was owed regardless, and the client had the use of the money for the additional time the tax remained unpaid. Malpractice due to an ethical lapse is rarer, but much more difficult to identify and fix. Face it, crooks are crooks. Crooks with many letters after their names are just crooks who've been to college. They know things that you don't. They know ways to steal and hide money that you've never thought of, and they have excuses and explanations ready and waiting to hand to you when you first begin to feel uneasy. The types of ethical malpractice are limited, but only by your imagination. There are numerous cases of elder abuse, of embezzlement, of fees charged for phantom work, of experts hired whose sole claim to expertise is the fact that they're Uncle Joe's nephew. The list is truly endless, and just when you think you've seen everything, something new comes along to surprise you. Just because you're in the dark about what someone is doing in your name doesn't mean that you're necessarily off the hook. If he turns out to be shady, remember you hired this person, and you're supposed to know what he's doing at all times. If your radar is going off and you're not doing anything to discover why, the court may find you equally liable, even though you had no knowledge of the misdeed. The key to finding malpractice is checking, auditing, or whatever else you'd like to call it. Don't assume that something is done just because someone has given you assurances. Check it yourself. Call the beneficiary to make sure that he or she received the distribution. Visit the elder for whom you're paying the round-the-clock nursing care. And make sure that a qualified nurse is there. Insist on receiving and then reading your quarterly or monthly statements. If you don't understand something on them, ask. If you don't like the answer, it's time to have someone else take a look. Covering your assets. Whenever you hire any professional to do work for you, be sure that person has adequate insurance. Just as you wouldn't let someone work on your roof without first being certain he carried liability insurance, don't give anyone access to your books and records without seeing proof that this person carries professional liability insurance, sometimes known as errors and omissions, E&O insurance. In addition, if you're acting as a trustee for a testamentary trust, as a court-appointed guardian, conservator, administrator, or executor, you will likely be required to obtain a fiduciary bond. Being bonded is a good thing. It provides you with protection in case someone decides you're doing a bad job. Unfortunately, if there is no bond required, you may have no insurance protection if someone brings a lawsuit against you. Talk with your insurance agent to see if you already have adequate coverage. If you don't, get some and charge the cost to the estate or trust. For non-testamentary trusts, those not created under the decedent's will, or if no bond is required for a testamentary trust, you should check with your insurance agent to see if your actions as a fiduciary are covered under your own umbrella liability policy.
All right. Thank you very, very much, Marie.
You're welcome.
Bailing my ass out there at the end. Appreciate it. I was getting so dry there, I couldn't. All right, so yeah, that's the end of part 1. Part 2,
Awesome.
starting next week, is going to be administering an estate. Let's take a look at that now and just kind of see how long the chapters are. Hey, Marie, how do you feel about splitting chapters since you have a book already?
Oh, fine.
All right, cool. Because I think that would work out really well for the both of us.
I'll bring my hot tea to the table next time.
You did really good, though. I was getting a little nervous. I'm like, oh shit, I might lose my group because she's better than I do.
Oh man.
So, all right, cool. So, part 2 starts administering estate. Chapter 5 is going to be taking the first steps after death. Chapter 6 will be navigating the probate process. And if we're ballsy and we can keep it going, and if we're going to be switching back and forth, we might try to get a third chapter in if you guys are feeling froggy. Ooh, chapter 8. That's going to be fun. Chapter 8, paying the debts, expenses, bequests, and deficits of from the estate. Yeah, this book, I'm loving it. I'm absolutely loving it. Well, thank you guys. What time did we start? 4 o'clock?
Yeah.
That's what, almost 8? That was a hell of a ride. That was a long ass time. I'm glad you guys stuck around. For the people that showed up late, don't worry about it. I keep this casual for a reason. I want people to be welcomed and feel like they can drop in anytime our meetings are going on. I would like to get us to a point eventually where other people are pitching in with books so that there might be a meeting every single day. Whether or not we can all participate in them or whether we have to catch the recordings. Even if we can get just 1 or 2 more people reading, another book each week, and that's that much more information that we got coming in, and and it's free and it's out there for everybody, hopefully. Assuming people don't decide to get greedy and be like, oh, I got this book, I'll start charging to read it. Assholes. So anyway, with that being said, thank you everybody. Have a good night. Enjoy the rest of your evenings. Thank you for spending some of it with me. Does anybody have any questions before we go?
I think I'll need a dictionary to know what the title for the next section means. Devices? Devices? What is that?
You know what? I've got my accounting dictionary right here. Why don't we take a look real quick?
Ooh, I just got a financial dictionary. I should put that in here too.
My Barron's Business Guides.
I think mine's a Barron's too, but it says something financing.
Yeah, they have a few different ones. I think I almost got the one that you have. Let me see.
Okay, I will be in tomorrow to get them changed. Make sure you take the deposit tonight.
Cal, you're unmuted.
Yeah, I wanted to ask John, were you gonna get in on this conversation with us later on?
What conversation?
Me, you, Ezel, and Tim were supposed to talk.
Oh yeah, that's right. Yeah.
I was gonna have you in the call with Bryant later on this evening, and then if it's something you want to turn on to this to the other group of people that are on your call, that would be great also.
Yeah. Drop his name right now. Give him a little shout out so he ends up in the video. And
his name is Brian Parker, and he's at Tactical Sovereignty, and he has a huge library that he's built also, and he passes that information on for free also. So the more people we get together that are serious about this, the faster we get through the smoke and mirrors.
No doubt.
Okay, John, I'm about to run and pick up my truck. I had to have some work done on it, and give me like about 45 minutes, and then I'll contact you.
All right, sounds good, brother.
Thank you. I appreciate this time, and
No, thank you, man.
I'm glad when we get to get everybody on the same gear and everybody confident in knocking down these walls. And appreciate your time, man, for sure.
Yeah, no doubt.
And I yield.
Have a good night, brother. I'll catch you soon.
What was that name again? Tactical.
Tactical Sovereignty with
Tactical
Brian
Sovereignty.
Parker.
Yes,
Hey, Marie,
Brian
what was the
Parker
word?
At Tactical Sovereignty. Brian, that is his Facebook page. I'm sorry, I forgot to mention that part.
He said he has big files, so.
Damn it. What was that chapter? I can't even find it now. What was that word we were looking for?
Devices. I don't know what it means. I don't know how to say it.
DEV.
Are you looking for him on Facebook, dear?
Not right now.
Okay. That's where you'll find his page.
Oh, it's not in this dictionary.
Well, maybe in the future, when there is a tough word, maybe we could just go through it during the break discussion time,
Yeah, we can do that. Absolutely. So, all right. Without further ado, everybody have a good night. Namaste. I appreciate your time. I appreciate you and your energy that you put into this. Sticking around
Thank you.
4 hours.
Yeah, thank you.
No problem, man.
It shows our dedication, right?
Yeah, right? No doubt. Absolutely does.
Thank you.
No problem. Anytime.
We do appreciate it.
Anytime. That's why I'm here.
This is what we do.
Exactly. You know, I spend all day at my job teaching people about natural ways to heal themselves. And then I come home and I work on learning ways to help people heal from the bullshit that this country has put us through. So, I mean,
man, you ain't lying about that.
No doubt.
Man.
So, all right, everybody, I'm gonna peace out. I'm gonna go rest for a minute. Do a little meditation, kind of chill out, smoke some water.
Hope you feel better too, man. Hope you feel better.
Bro, dude. Whew. I'm telling you, I wasn't even out of bed until almost noon today because I was still having. I got this tincture called Stonebreaker that's got some a few different herbs specific for breaking up kidney stones, and I plowed through like 2 gallons of water and that whole tincture between about 4 o'clock yesterday and noon today. Just
jeez.
I didn't really sleep last night because I spent most of my time in the bathroom.
I don't blame you. I mean, you going through hell.
Yeah, it ain't fun, but it ain't feeling too bad right now. So
no,
told you. But all right, I will catch everybody.
I see you got your Superman shirt on, so I know.
Yeah, you know what, dude? Most of my wardrobe is Superman. I got so much Superman stuff in my house. Pretty much the idea is I'm manifesting that shit into my life. Flat out, I ain't gonna be satisfied until I'm flying over skyscrapers. That's the world. I don't give a fuck what anybody says. You can call me crazy if you want to, but Ralph Ring says that we don't need
I'm right there with you.
Anti-gravity craft, so I know we don't need no anti-gravity craft. And that fool's been building anti-gravity craft since the 1940s. So if that man knows his shit, and if he says that we can if he says we can fly like bumblebees, then I'm gonna float like a bumblebee, sting like a bee. Shit.
Oh yeah.
I'll catch everybody.
I'm
later.
like this, man. What's understood upon?
You know. Peace.
Yes, all right. Thanks again. I'll catch you later. All right.
Yeah, no problem. Anytime, everybody. I'll see everybody on Wednesday. I'll see everybody on Wednesday for the UCC workbook.
Okay, what time?
That one will be 7.
7. So that'll be 7 your time or 7
7
California
Eastern.
time?
7 Eastern.
Okay, gotcha.
All right. All right, everybody.
All
Peace
right.
out.
Later.